welcome to our Multifamily Investor Nation webinar today, focusing on kind of budgeting 101. A lot of people think this is a pain to do every year, and it is. But like maintaining your vehicle, if you don't do your inspection and your budget to start the year and then follow up and maintain it, it could cost you a lot in the long run. So basically, there's three areas that we like to focus on when we are doing budgeting. Typically, we would start in the third quarter of the year and start to review our historical progress in the property. Part of that is looking at the operations of where we stand to date, looking at our goals of where we would like our properties to be in the next coming year, whether it's fiscal year or calendar year. Just an FYI, we do everything on the calendar year. So when I speak, I'm talking calendar versus fiscal. So we want to understand the baseline of where we're starting from and whether or not there are any pitfalls with our properties and things like that. The next thing that we look at is the market conditions. So I'm going to go through a couple of sources that we use to kind of give some color as to what's happening in the market. That doesn't necessarily dictate where you how your property will perform, but what it does is give you guidance as to what's driving the market and how those influences may impact your operations for your property. And then lastly, we will kind of dig into where we go from a 30,000 foot level and then down into the minutia of the details. So I'm going to share with you a couple files that I use that are part of our review process. So I'm going to start sharing a couple things. So right now I'm showing you kind of my tracking sheet that I look at on a weekly basis. This gives me an idea of where we are, where we're forecast to be, and what our current operations are. So this gives me the baseline performance for the property. By setting up these kind of KPIs, they allow me to see how the properties have progressed over time, and then to go back in time, week to week, month over month, year over year, to see what the trends are with our property and how our property performs specifically to other assets in the marketplace. Because of this, it gives us an indication of where we have been. So it's a rear-looking model, but it gives you a very, very strong indication of what how your property is performing. So I can go back as far as I go track this weekly, and gives me all the information that I need to let me know what the collections percentages are, what our rents are, what our occupancy is. So it helps me figure out what the ebbs and flow are, so that when I put together our budgets, we can look at not just a macro year-end number, but also a month-to-month number. I'm going to stop sharing this now, and oops. I apologize. I'm new to this sharing stuff. So with that being said, we then start at our market research information. So there are two sources that we tap into at a 30,000 foot level, and I'm not sure, and I'm going to ask Talia, can she see the PDF that's on the screen right now? Because I can't tell what I'm sharing. Okay, for a second. Well, hopefully everybody can see my screen. Oops. I'm going to share a different screen here. Okay, hopefully you can all see the screen that I have. There we go. This is a document from CoStar that gives us macro information about occupancy trends, rent trends, things like that. This is not something that's free, but there are a number of free resources that you can get. And I'm going to switch tabs to one that's called Yardi Matrix. They have good information about the rent forecast. So for 2024, they are forecasting the national trend to be relatively flat. That is an indication of, okay, at a 30,000 foot level, here's where rents should be going for the year. Nationally, year over year, rents only increased by 0.3%. And they break it out by market. So it gives you an indication of, okay, if you're in New York or Columbus, they experience strong rent growth. Charlotte and Austin and Orlando had negative rent growth. That is macro level, including all properties in the market. The problem with that data is it doesn't necessarily show you exactly what is happening for your specific property. So this is just a directional that you want to look at. I tend to also look at market level information that we gather, not just from brokers and other real estate information providers that will give you a micro market. So a lot of times you can get this information for free from brokers. They will tell you what your forecasts are for the market. I can say this, that when we look at the national year over year rent growth for Orlando, they said it was, let's see, negative almost 4%. We experienced actually 4 to 5% rent growth in our portfolio in the Orlando and other Florida markets. So you have to set your budget with not just saying globally, hey, we're going to forecast flat rent growth because Yardi or CoStar said it. So we are going to do it in a way that best matches what we think is happening in the marketplace. So at that 30,000 foot level, you want to make sure that you have good, strong indications as to what's happening. So if I were to just use national averages, I would have been forecasting flat rent growth for the year for our portfolio, because we have assets in Charlotte and in Orlando and Nashville, and all of these markets show negative rent growth. But our portfolio as a whole, we saw positive rent growth for the year. So that is why we want to look at a lot of the information from the national level all the way down to the micro level. So I'm going to try and stop sharing now. Hang on. Oops. There we go. Okay, there we are. Now I'm stopped sharing that. So with that in mind, we have this national information that we've pulled together. We've done benchmarking and comp information for all of our properties. So now I want to start to look at how we view our data from a micro level. So I'm going to pick one of our properties that we have, and I'm going to share another screen if I can. Oops. To share this. Hopefully you can all see the spreadsheet that we have. So this is one of our properties in Orlando. When I put together the information, basically I'm asking our management company, here's where we underwrote the property when we bought it. Here is our 2003, this is our actually November information of where we were in November year to date or forecasted out for the end of the year. And then we go in and say what specifically can happen for this property and where we think the trajectory is. So this takes into consideration not just our team in place and where they think they can push rents, but it also takes into consideration the forecast for what's coming online for new developments in this area. What new properties are happening? What are their rents going to be? How does our property compare to those properties? And will we be able to take advantage of the price differential between a new asset and an existing stabilized asset. So for this property, even though they're forecasting low rent growth in the Orlando market, we see ourselves being able to push our rents slightly higher, just because in this specific area, this specific asset has the ability to push the rents and take advantage of the price differential between the new product that's coming online just adjacent to it. We want to set aggressive goals, but we don't want to set unachievable goals, because we don't want to have this information going out to lenders, et cetera, showing where that we're being overly optimistic or setting too high of expectations. So what you can see is when we put our numbers together, when we underwrite, we're not getting into the minutia of each line item. But what we have to do is ensure that our data points match. So, for this one, we thought, hey, our rental income is going to be, other income of $850,000 when we underwrote. And again, this isn't just our initial underwriting for year one. This is our detailed underwriting for, this would be year 3 of the investment. So we forecasted out what our growth is going to be, and we're trying to see how we compare to where we are, both with our underwriting and in reality. So we're showing relatively small increases in other income, just because, again, inflationary factors push those things forward. And again, when we look at the main line items in our budget, there's items that everybody knows. There's controllable and non-controllable expenses. So we don't necessarily control real estate taxes, but we can appeal if we think there's an error, and we make those as a somewhat non-controllable expense. Although with appeals, you can try to lower those expenses. Insurance is another one where we don't necessarily control that. Somebody else dictates what our insurance costs are, but if you competitively bid your stuff, you can get the information down. So then we look at what we can control. Our management fee is fixed. It's a ratio of costs against our revenue. But things like payroll, repair and maintenance, turnover costs, utilities, those are things that we can control. So we go in and we'll look at all of the specific line items and see where we're spending our money, and if there's any ratio that doesn't necessarily fit where we're trying to be. That's where I go back to the benchmarking aspect of looking at other data from across your portfolio, and also from third-party sources. Like we get information from CoStar and from Yardi that will give us at a macro level, MSA level expenses. So we can go in and look at a line item and say, hey, our insurance costs are, 21% of the total costs, or what are we saying here? $1,000 a unit. We can go in and see how other properties' insurance costs are on a per unit basis, and ensure that our numbers are fairly accurate. So when we look at our budget, we want to make sure that nothing gets out of sync with regard to historical data and our benchmarking market information. So that allows us to make sure that when we're coming in and I'm looking at our expenses and we're at a 40% expense ratio, that's a pretty strong number. That allows us to continue to manage our portfolio efficiently. What I then do is I ask our management company to go in and break everything down on a month-to-month basis. So I am going to, again, stop sharing this, and I will show you what our budgets share. Okay, hopefully you guys are seeing our there we go. You are seeing our detailed monthly budget. So this is where our management company will come in and break out all of our expenses on a month-to-month basis. Now, I've rolled this up into a high-level category, so I can compare how our management fee stacks up to the management fees and the CoStar data, where our taxes and insurance numbers are, how our payroll is. So again, all of these ratios that we're looking at allow us to determine where we are compared to other properties, and are these goals achievable? So that's the basics for setting a budget. Now, all of that hard work that we've spent 3 or 4 months working on, I'm going to stop sharing here for a second. Perfect. So all of that information is great. So we now have a budget, we've reviewed it, we've signed off on it, and we are projecting we're going to grow to this level. That's great. Now, one of the pitfalls most people fall into is they never look at their budget again. That is a problem. That's why when we move forward with our budget, it is a tool that we use to now measure our performance going forward. So on a weekly basis, I look at what we budgeted our occupancy to be for the month of January and compare what my weekly occupancy is and where we're off. So that allows us to then make decisions as to what do we need to do to get back to that budgeted number, and how are we going to use that to improve our marketing or improve our closure rate with regard to our leasing activity. So when I have our biweekly calls, I can sit with our management team and focus on solutions to getting to back to budget, or helping make adjustments that says, hey, we are at 98% occupancy, we are only budgeting to be at 95, maybe we should start increasing our rents a little bit. So by using your budget as a tool to help you achieve your goals, that is where that's where you actually make your money and earn your stripes as an asset manager, is staying focused on achieving those goals. Because again, if you don't look at your budget and you don't spend time and effort setting a strong budget, you don't have anything to measure against, and that is critical. Budgeting also, if you utilize this process, it will also play for other aspects of your management. So when we look at landscaping work, part of the process is establishing a very detailed scope of service. That's basically the budget. This is what work needs to be done. So then we can go out and ask our vendors to give us bids on things that are apples to apples, so you can find a true comparison. Because if you are asking a landscaper to mow once a week and somebody comes in with a bid that's lower, but they're only mowing once a month, that's not necessarily saving you money, because it may impact the quality of your asset. So that process of having a detailed review for budgeting purposes is really important to follow through all aspects of property management. With that being said, I am going to open it up to questions. And I don't know where all of the Q&A is. There we go. Does anybody have any questions? Any questions on anything outside of budgeting? What screen are you looking to see? Are you looking for the budget screen or the market data? Oh, your budget screen. Okay. Hang on. So this is our monthly budget screen that we have that we are that we use to detail out all of the information. Now, the data behind this is very, very detailed. So it goes line item, geocode by geocode. We break it down into a very, very detailed analysis so that when we get information that comes in, like let's say one of the big issues that we end up having is technology fees. So a lot of times we'll get a service invoice that comes in that's for the whole 12 months, but it hits in a single month. If we see that, we can actually amortize that over 12-month periods so that any individual month won't get hit with an enormous invoice for like a big, $20,000 licensing fee or something like that. So we do break everything out into a monthly budget. When I track data on a weekly basis, that's for trending to see where we are going with regard to like occupancy. I can see what our traffic is at the property. And if our occupancy is dropping, then I can dig into it and identify what is the issue. Is it that we're not marketing enough? We're not getting enough people in the door? Or is it a closing rate where I look at the traffic that's being generated is great and we have 10 or 15 tours a week, but we only sign 2 leases. So that leads to, two directions. It could either be we have a closing issue where our leasing agent isn't trained on how to close the leases, or alternatively, our marketing is targeting the wrong quality of resident. So we get a lot of people touring, but they don't qualify. So all of these things that you set when you budget, again, you want to make sure you're able to not just understand what the numbers are supposed to be, but also they should lead you to a solution as to how to fix something that's identified as a problem. When determining the rise in rents, as you stated, based on budget, when do you include market rents and how do they relate to each other? Okay. Well, our management company uses a system called YieldStar for setting the rents. So that gets adjusted on a daily basis. But one of the things that we do as part of our budgeting process is we do a detailed market study at the beginning of the year to see how our rents compare to the surrounding properties, specifically not just the assets that are in our class, but also the ones that are slightly above us, because while our portfolio is mostly Class A product, there's always a newer, shinier property on the block. So we want to make sure that we are striving to be competitive with the new product, but also be priced slightly below them. So we give people an alternative that say, hey, instead of spending $2,200 a month on this brand new property, you could spend $2,100 at our property and have the same benefit. So those are the things that we look at. But again, that's something that we also look at on a weekly basis as well. I have charged our management company with pulling comp data so that we can ensure that we are comparable to other assets in the marketplace. Okay. Let's see, are there any we don't necessarily budget our rent on a weekly basis. We basically forecast the rent on a daily basis based upon the YieldStar model. I have overridden that sometimes when we start to think that the rents are being adjusted too much. But when we look at the budget, we are forecasting where we think our rent should be in a given month and saying, this is our target rent number. So what do we need to do to achieve that number, staying competitive in the marketplace? So I don't budget weekly. We budget on a monthly basis, but I review the data weekly to ensure we're on target to achieve those goals. Any other questions? Just making sure I'm following up on everything here. Anything else? Okay, someone wants to see. Uh, the market screen. Oh, the data from Yardi. I can do that. Hang on. So let me. Share. Okay. So this is actually a free report that you can get from Yardi Matrix. They do a number of sub-market reports that you can get that's free. And then also they do detailed analytics if you pay for that service. But the Yardi report is pretty comprehensive with regard to data on new starts as well. That's one of the things that's really going to drive a lot of the demand for, or not demand, the impact on your occupancy and your rents. They are forecasting up to 1 million new units being developed across the country in 2024. That number is consistent with what we see for CoStar. But that demand, that new supply is actually going to start to diminish over time. So 2024 is going to be a heavy supply market where a lot of supply is coming online. Then it's going to start to diminish in 2025 and kind of flatten out by 2026. A lot of this is dependent upon, if you look at the information from both Yardi and CoStar, where interest rates are. Construction loans are in this 8 to 9% right now. So it's very expensive for these builders to put product out there, but a lot of them have already committed so much money to doing these developments that they're not going to stop something mid work. So a lot of these permits for the future 26 and 27, they've kind of backed off on those and are not starting those work. So I would foresee the supply starting to shrink in 2025 and 2026. Okay. Let me just double check, make sure we don't have any other questions. All right, going once. Going twice. Oh, here we go. Here's one. Is your budget delivered from your underwriting data? Not really. What we do is the underwriting starts the process for us. The underwriting is actually our initial budget. So when we take over a property, we use our underwriting as the initial budget, and then we ask the management company to break it out into the detailed GL codes that we have. From that point on, what we're doing is we are establishing the budgets each year based upon real life market conditions, not a forecast. If there is a deviation from the underwriting, what we do is we will put together that comparison that I showed, and I'll stop sharing this and I'll pull up that other screen. Yes. So what we did here is we are comparing what our underwriting numbers are. I'm just going to go up to the very top of this here. So when we look at this property, I look at what our final underwriting was for this specific period. Like in this model, I think we're in month 22 through 36. as our 34 in our underwriting. So we are comparing what we thought our numbers would be when we purchased the property in 2022 in our underwriting to where our budget is in 2024, and then also where we were compared to last year. And in this report, that's where we come in and we'll plug in our notes of saying, you know, the variance of why something is off. Well, hey, payroll has gone up astronomically with inflation to keep good staff. We didn't forecast 3 years ago that inflation would be as high as it is today. So we missed on our payroll numbers. So this allows us to understand where there could be some improvement when we underwrite in the future. So that's one of the reasons why we do this comparison, to see how we are forecasting every time we underwrite a deal to acquire something. Okay. Market becoming saturated, cheaper sale prices. I think the driving factor for multifamily is always going to be demand. The reason why people ramped up construction was twofold. One, in certain markets, especially in the Southeast Sunbelt, there was a lot of population growth, people moving. So that was driving a lot of the demand into those markets. Those markets were undersupplied. So there's a balancing act, because the lead time for permitting is so great. I mean, it took us almost a year to get a permit just to replace a roof at one of our properties. So that will always be a delay for the supply coming online. The good thing is, even in some of these markets that have a lot of supply coming online, Orlando, Charlotte, Austin, Texas, Houston, they are still forecasting strong population growth. That strong population growth will balance out in the end, but it will cause some short-term depression of rents or capping of rents. So I believe that in certain markets, you are going to see a decrease in rent just because the demand drivers are starting to dry up. But in good markets, strong markets like Florida and in Texas, where you still see the big population growth and job growth, you are going to see maybe not decreasing rents, but a flattening of rents until the supply pipeline shrinks, and then you can start pushing rents again. Interest rates are going to drive everything with regard to the value. So right now, with interest rates stabilizing, I think you're going to see a lot more product coming on the market. Any other questions? Oh, the interest rates with big funds buying single family homes. In one of the articles that I read that was from Yardi, actually, institutional owners of single family homes is less than 1% of the overall housing market. And in the build to rent space, it's less than 5%. So while there is going to be more movement of institutional funds coming into the single family rental market, it's not going to be able to move the bar significantly, because there's such a small percentage of the overall housing rental market. So it will have some impact, but I don't think it's going to be that great of an impact. Interest rates are really going to drive that factor more than anything else. Yeah, I mean, immigration will have an impact on demand, but again, it depends on your asset class. If you are in the workforce housing market, yeah, that will have a significant impact, where I think the class D and C rents are going to be able to show signs of life and increase. The Class A rents are the ones that are probably going to stabilize. And the beauty of the Class B product is if people are priced out of Class A, they're just going to roll down into a B asset. As rates start to increase on the C product and people move up because the job market is still strong, the B asset classes are going to have some strength and growth because you're getting pushed from both sides of the people moving out of the C class assets because they're getting better jobs will move into a B class asset, and people that can't afford the A properties are going to move down into the B plus properties. So I think Bs will be relatively stable. Where the big risk is right now is in the Class A's, because if the market slows, that's where the percentage of people's income going for rent will start to be harder to justify for a Class A asset. Any other questions? All right. Well, thank you all for joining us, and look forward to seeing you guys on the next webinar. You guys have a great rest of your day.